Kia ora, ngā mihi nui kia koutou. E na rau rangatira mā nau mai, haere mai, whakatau mai, ki tēnei hui mariko. Ko Barry Coates aho, ko te kārahi o te patea whai whakaro, nā reira tēnā koutou, tēnā tātou katoa. Tihe Mōri ora. So a very warm welcome to you all. I'm Barry Coates. I'm CEO for the charity Mindful Money. We promote ethical and impact investment, and it's impact investment that is the topic for today's seminar. So this is the 8th seminar in our series. They're held on Wednesdays at 12 midday or 12:15. Videos and podcasts of previous seminars are available on the Mindful Money website, on YouTube, and on some other websites. There's a fascinating kind of list of previous seminars, so I hope you take a look at those, and essentially it's kind of a library of approaches to ethical investing. So as I said, today the issue is investing for positive impact. And by that we mean that your investment has positive outcomes for people and the environment. And some examples are investment in social housing or renewable energy. So this part of the investment world is growing rapidly. It's driven particularly by consumer demand. And people are realizing that their investment can not only avoid creating harm, as in a way the typical situation with ethical investment, but also can lead to positive outcomes while earning good financial returns. For many investors, this is a sweet spot. It's also a public priority, given the urgency of global challenges, investing for climate transition, investing to regenerate nature, and supporting poverty reduction. I wanted to just do a quick note to start off with, and it's about the definitions. There's been a lot of debate around definition of impact investing. It probably has bypassed a lot of people, but it's worthwhile providing a little bit of background. In this seminar, we're going to talk about two types of impact investing. One is a positive investment, the positive benefit that comes from the investment itself. And so an example would be funding a wind farm or funding a social housing bond. In those cases, the project probably wouldn't have happened without that investment. So there's a direct attribution, and it's what we call direct support for the impact company through investment. But we're also going to talk about indirect support. And this is where you invest in a company listed on a share market, or you're investing in shares, or in other cases, bonds. And in those cases, when you invest, your investment actually buys somebody else's shares. So it's not the same kind of direct support. However, when a lot of people invest, the company's share price rises and their cost of raising money falls. So that indirect support makes it easier for the company to scale up, and it reduces their cost of funding. So a good example of that was shown a couple of years ago in the case of Meridian Energy. There was a surge of investment that rapidly increased its share price by 40% in late 2020. And that meant that its cost of capital or cost of funding was significantly reduced. So that's a kind of example of where there's a relationship between investment indirectly and benefits to the company, and ultimately an impact on, in this case, renewable energy and climate change. So I hope that explanation helps. It probably just makes it all more complicated, but we're dealing with impact investment, and some we'll try and go into some of the complexity of this during the seminar. Before we start, I should let you know that we're talking about some specific funds, and but this seminar is about financial strategies, about investment strategies. It's not financial advice for you as an individual, or a recommendation to invest in a specific fund. So please accept this kind of disclaimer about financial advice, and if you need to, if you have any questions, you should go and see a licensed financial advisor. To start us off in the seminar, I'd like to introduce Melissa Yiannoutsos. She's the fund manager for Booster Innovation. Melissa's been with Booster since 2021 after having senior management roles within the biotech sector. So very strong science background. Melissa, welcome. Can you tell us about the Innovation Fund and its impact investments?
Yeah, thanks, Barry. It's great to be on your show today, and it's really interesting to see now the many more ways that investors can really put their money to work to achieve impact while also generating returns. So it's good to be here. And, as you mentioned, we've actually listed our newest fund on the NZX, would have been last year now. And that was kind of a long time in the making. It kind of took us 5 years to really stand up this fund. And that started firstly with the partnership with the commercialisation offices at Victoria University of Wellington and also Otago University. And this was an important step because it gave us access to many of the smart academics that are really tackling quite major challenges, whether it be climate change, so looking at ways to develop new fuels, and also addressing major health issues. So this stepped us into the realm of investing in really young companies. And now the Booster Innovation Fund is backing over 30 companies, and there's such a range of challenges that they're addressing. And so really what we were looking to help stand up in the marketplace was a fund which allowed all Kiwis the chance to kind of get involved and back young companies that have these global ambitions. And so one of the challenges prior to this was finding a way to really address what is often a very difficult asset class to access as a retail investor, and also supporting these kind of companies when the liquidity timelines are different. And so setting up the fund allowed us a way to create liquidity in what is traditionally an illiquid asset class. And it also created a way for all to have the opportunity to support these kind of companies that really, if successful, we've got to be mindful because we're stepping in and investing in these companies early, some are going to really fly, but some will fail. And the approach to building diversity in the portfolio is really one key to help people manage that investment risk when you start to come into this end of the market.
Melissa, can you explain a little bit more about how you handle that liquidity issue? Because obviously these 30 companies you're invested in don't trade all the time, and you can't buy and sell their shares. How do you maintain liquidity in the fund?
Yeah, so the investing directly in the innovation fund and it being listed on the exchange does create the ability for investors to buy and sell on the NZX. So you're not reliant on the company to sell its shares to then realise the benefit. What we do encourage investors in the fund, though, is to take a long-term view because some of the really more substantial returns are going to come in a longer investment cycle. And as those companies succeed and they have a liquidity event, or they might be acquired, or they might list on the stock exchange in their own right, that creates some disposals, which then, being an investor in the innovation fund, then creates the mechanism to get some exits from some of those first investments.
Yeah, it's probably worthwhile just going into that a little bit more so people who may not be so familiar with startup companies kind of understand that period of growth where essentially you, as you described, a sort of liquidity event or a disposal of the company. So a lot of small companies actually have in mind a staged approach where they would progressively scale up their financing or sell out to a bigger company,
Yeah.
and that presumably determines a bit the timetable for investment in the fund.
Yeah, I mean, you're typically wanting to think about when you're investing in young companies to take at least a 10-year kind of investment horizon timeline. So, I mean, one really great New Zealand success story that we've seen is Lanzatech. I mean, this company has been 20 years in the making. So those investors in the early days really backed a company that had an idea of how to use microbials to capture carbon dioxide and repurpose that into carbons that could be used in many different industries. Those investors have been patient, grown with the company, and that company is now listed on the NASDAQ stock. So that means they can now get a way out of that single holding in that company. Contrasting that to investing in the innovation fund, you get a little slice of over 30 companies. You don't necessarily need to wait for one of those companies to create an outcome in the long term. If you can find a buyer for your shares on the NZX, you can buy and sell in your own time horizons rather than at 20 years. So investing in a portfolio that has some really young companies and some mature companies, you can kind of smooth out that timeline to value growth.
Cool. Thank you, Melissa. That's really good, and we'll come back to some of the impact characteristics of the companies you've invested in when we open up for the panel discussion.
Yes, yeah, looking forward.
Cool. Let me introduce Simon. I'm very pleased to welcome Simon Pannett. Simon is manager of the Sustainable Impact Fund at Harbour Asset Management, senior credit analyst at Harbour. He's had lots of experience internationally and in New Zealand on investment analysis and management. So warm welcome, Simon. Perhaps if you can start off by describing the Sustainable Impact Fund.
Kia ora, Barry. I'll just start with the motivations for launching this fund. Back in December 2021, we launched the Harbour Sustainable Impact Fund. And the driving force there was, as you mentioned in your introduction, we thought there was a cohort of investors who weren't satisfied to simply exclude companies that cause harm, but they wanted their portfolio to be populated with companies that were delivering positive outcomes, solving the world's problems. And when we started out, in truth, we thought of this as an Australasian equities fund, but we soon discovered that actually it was the number of available companies was just too narrow, that it would be quite a highly volatile portfolio and perhaps inappropriate as a standalone portfolio. But also thinking more about that and the topic of today's podcast, mainstreaming impact, we thought that that wouldn't solve their entire portfolio problem either. They'd still have to think about what they were doing with their other asset classes. So what we've created with the fund is your classic balanced fund. It's invested in international equities, domestic equities, and fixed interest, as well as a mix, or predominantly skewed to listed market, so public investments, but it also has some private investments. So
cool.
That's our fund.
And Simon, when you say the sort of the motivation was to offer a sort of a positive option, was that because you perceived that customers are increasingly interested in this, or did you see kind of financial opportunities for good returns from the positive impact companies? What was the real kind of driver there?
It's a bit of both, Barry. Yes, we had heard feedback that this is what clients wanted to do with their portfolios, but also I think the argument for the financial returns is strong also, right? The world faces a lot of challenges, and rewards go to those who solve them.
Yeah. Great. We'll come back to those issues. Let me bring in Melissa again, and I'll open up panel discussion with a sort of a question around how you think of impact, and for you, Melissa, you typically don't necessarily talk about the innovation fund in terms of impact, but you have a lot of companies that create impact through their operation. How do you regard that question of the impact of a company in terms of your portfolio selection? Do you go out looking for impact companies, or is it just the way you perceive there's going to be good returns from those companies? As Simon said, is it because that's way the global challenges are lining up around climate change and etc.? What's your thinking on impact within the fund?
So I think, I guess we don't deliberately, talk to impact investing. What really underpins a lot of our focus is, being socially responsible with our clients' money, and then marry that up with a lot of the great innovations that are coming out of New Zealand, which are really directly looking at this impact. So, new ways to fuel the economy, new ways to feed the economy. So a lot of what we're privy to through our relationships with the private sector and the universities, it does tend to pull out a lot of those opportunities. And when you want to invest in young companies, they need to have this global ambition, because if we're wanting to generate returns, we really need to think about, how to have that positive impact for our investors through supporting these kind of companies. And the other thing at the heart of it really is how we start to shift the fabric of the New Zealand economy. And investing in these kind of companies ticks all those boxes. How we kind of invest in helping primary sector industries also start to transition or leverage their asset base by applying some of these new innovations. So inherently in the way we think about that, being responsible with our investors' money does come through in the kind of companies that are attracted to us and that we're attracted to.
Yeah. Can you give us some examples of some of these good young companies that you
Yeah.
invested in?
Yeah, there's 30 in there, Barry. So,
We all love hearing about the stories of some of these great companies.
Yeah. Well, there's a couple I'll spotlight. So, X-Frame is one company that originated out of Victoria University here. And so what Jed and his team have really developed and are selling now a clever modular framing system for use in construction. And what their system allows is to be able to construct, also recover, and then reuse a lot of those building components. So they're reducing a lot of building waste. And what's really important as this business starts to build its market share is that 40% of all the waste is a result of construction and demolition of those buildings. So if we support companies like X-Frame, they're really bringing through a solution which is about a whole circular construction economy. And then that has the potential to reduce CO2 emissions by 30%. So this one company, innovation that's come out of Wellington here, and now really gaining traction internationally is, one example around how to address some of those issues around building waste. And then we've got, I'll tell you about another one, just because the other way we think about impact is, how do we get new solutions for food systems? We've got a limited kind of footprint in which to grow and produce food, and we're in the middle of a hunger pandemic. So finding new ways and new solutions is kind of really what attracted us to Biolumic, which is a company in Palmerston North, which came out of Massey University. And what they've managed to do is develop UV technology that delivers ultraviolet rays to seeds and seedlings. And that's very smart. So you're kind of thinking, what the sun does to trigger biological mechanisms in plants. And what they've shown through their systems is that they can increase the yield of soybean production by about 39%, and yield of strawberries, by 47% per plant. So you're starting to see how when you support these kind of companies and they get scale, they attract other larger investors, you're really starting to bundle together all these kind of companies to have a pretty important impact. Because it can be quite daunting, as an individual, how do you actually participate and support? So, yeah.
Exactly, because typically you have to be a sort of venture capitalist, often a wholesale investor, and so this is a kind of a much easier access for people.
Yeah,
So
well, it
moving to
helps
you,
it helps a KiwiSaver client get their money to work for these kind of missions, right?
yeah. Moving to you, Simon, you're typically investing in companies a little further along the growth path, shall we say? And how do you look at impact and in the Sustainable Impact Fund? What are your criteria for choosing impact companies?
Sure. Well, every investment in the portfolio has to be making a positive contribution, making a positive impact, and we define positive impact as contributing to one of the United Nations Sustainable Development Goals. And so our job as analysts is to find companies with a positive impact case and present an impact thesis for each of them. There's a number of criteria in those impact theses which kind of get bogged down, and as you said at the start about the definitions of impact, but one of the key aspects is the intentionality, their intention to cause impact.
Yeah, and it must be a bit tricky mapping it onto sort of broad themes like the Sustainable Development Goals, which tend to be very high level. Do you have particular kind of ways of drilling down into how that contribution works from the company into those lofty goals?
Yeah, I think this comes to measurement, and measurement's just such a key part of impact investing. One, because I think that more broadly responsible investing has been tarred with a greenwashing brush, and that's what part of Mindful Money's purpose is, protecting against that. But it just makes it so important for impact investing, which is at the more grunty end of responsible investing, to protect its credentials with measurement. So we have to be able to demonstrate that impact to investors. And it's really hard, Barry. There's a couple of dimensions. One, at the individual company dimension, being that some of these companies are in making an impact with new technologies, and it might be nascent, and therefore it's really hard to measure. And it might be you really want to measure the impact, but sometimes all you really have is an input into that output. And so what we look for, we don't be so purist and need, for example, lives saved, etc., but a proxy that demonstrates what the company is intentional in delivering an impact. So that might be the research and development spend, for example, but it is a proof point to link what they're doing to an output. So that's one dimension. And the second dimension of measuring it is you want to give investors a sense of what the portfolio is doing in an aggregate. But like I said, we are investing across the United Nations Sustainable Development Goals, so it's not in one dimension. So we have to find metrics that can distill it for the investors, because it's not realistic that they have time to consider every holding. So there is a number of proxies and measurements that can give people a sense of the portfolio in its entirety.
Yeah, and congratulations to you guys on producing your impact report. I think you've done a good job of kind of looking at how you would represent that impact and a few nice case studies in the report. Do you want to talk about one or two of the companies that are in the sustainable impact portfolio?
Yeah, sure. Well, example I really like is an ASX listed company, Calix, and they have commercialized a technology for carbon capture in the production of cement. Cement makes up about 8% of the world's man-made CO2 emissions, so there's a huge opportunity set here. The technology also is used in lime production and some other industrial processes. A huge opportunity, and they have on board their client set Heidelberg Cement, one of the top 5 cement manufacturers in the world, and so that's it just shows the potential scale of that impact. Also, just to prove that it's not just environmental, we're looking across other dimensions. Another new holding in the portfolio is also ASX listed firm called APM Human Services. They do a range of things, but their largest business line is employment placement. So that might be the people that are chronically ill, perhaps disabled or long-term unemployed, and they find them jobs. They have contracts with 11 governments around the world. But they also do things such as go into homes of elderly people and make assessments that will help them stay in the home for longer rather than having to go into care, and that might include things putting in ramps or lifts. So there's a couple of equities. I turn to the bond side where my role is, the co-managed fund. It's arguably a little bit easier in bonds because you don't have to, with equities, you're funding an entire business, but with bonds, there's new instruments now where you can fund just some of their assets or perhaps a specific project. And these typically have a label like green bonds. But for us, it's not just about buying green bonds. We want to do further checks on the business to make sure that there's sort of a do no significant harm check across the business, and green doesn't necessarily equal impact, but predominantly when you look in the portfolio, you do find things like green bonds and also sustainability linked bonds. These are bonds that pay a coupon depending on the achievement or non-achievement of a sustainability goal, and so to that end they are providing an incentive for a firm to create a positive impact.
Thanks for those examples. It's also nice to have some social examples because people's thinking often goes directly to the environment or climate change. So that's great. Can I broaden out the conversation for you both by talking a little bit more about impact funds across the investment sector in New Zealand? What we see is that there's relatively little New Zealand investment in impact, particularly compared to some of the other markets where impact is a bit more mature as a form of investing. What do you see as being the opportunities for scale up? It's kind of, I mean, the question is kind of how much could this grow in New Zealand? Could it be a significant factor in what mainstream funds do, or is it going to remain very much a kind of niche activity that only attracts maybe a few percent of overall portfolios? Maybe you first, Simon.
Yeah, I'm going to be very interested in your thoughts sitting across the industry, Barry, but maybe I could share our experience having launched this fund in December 2021. And the truth is that we've attracted $6 million and we're a $7 billion fund manager. The research we see suggests that people really are behind this. And indeed, that's what the engagement we're having suggests as well. But I, without being scientific and just anecdotal, what we've experienced is generally our clients set, we don't have a huge mass market brand. It's more through financial advisors, for example, and they tend to want to see products have a track record before allocating their money. So it's a case of good things take time, I think.
Yes, it's kind of like people are thinking of it as a new asset class, and they want to make sure that it has a track record
Yeah.
before they invest in it,
But
rather
sorry, just
than perhaps an extension of what's already happening. Yeah.
yeah, and particularly I'm thinking in our space, which is a sort of mainstream listed fund. But there are a number of other funds that would just make sure we be remiss of us not to mention that there are other funds that have been established for quite some time. I can see on the list of people calling in today, there's this, for example, Bill from Purpose Capital and Jackson from Aquino and people from Newground Capital. So that these funds have existed, but it's certainly a growing and movement in its early stages, and that's what you see overseas as well.
Thanks for mentioning that. And yeah, kind of there are wholesale funds available to New Zealanders for impact investing. And as you say, some great funds, Purpose Capital, Impact Enterprise Fund, the work that Community Finance has done on social housing, etc. So there's some great examples out there, but we're not seeing much in the retail space, and it's I'm interested in that slow take up of investment and the Sustainable Impact Fund, because when we do surveys, there's a lot of public interest, but obviously it has yet to translate into investment. Melissa, how does it look from your side?
Well, I guess the research that we're doing is, our customers are looking for ways to support positive impact, but also, having that return in there too. So seeing them come hand in hand. And I guess, stepping the Innovation Fund up into the NZX listing does provide an accessible way and starts to address some of the challenges of that long-term nature of investing. And so that is, one strategy to help build scale over time. And people are, having to appreciate that it does take time, because as you both have said, measuring impact is going to evolve over time. I mean, in our particular case, a lot of the companies are pre-revenue. They have big, ambitious ideas, great technology solutions, but they need time to really eventuate. And so some of our companies can already measure the impact, but some will bring that in over time. So I think, that dual focus around how do we impact at a global level, but also how do we impact, and I mentioned before, or future-proofing New Zealand's economy as well, and how do we build these companies that have high-paying jobs, and so then you start to improve the standard of living across the country as well. So you kind of see this knock-on effect by helping build some of these companies locally.
Yeah. So as Simon alluded to, Mindful Money is doing some work in trying to say, what would it take to accelerate impact investment, particularly through mainstream investing? And so part of the idea of inviting you two on was to talk about some different strategies. In one case, a fund very much with startup companies. In the case of Harbour's fund, a dedicated fund on impact. There are others who incorporate some impact investment into their mainstream portfolios. For example, KiwiSaver's done some work on social housing. Simplicity's doing some work on both social housing and simplicity living. There's a number of other mainstream funds. Pathfinder's got some work on impact within its portfolio. And so those are different strategies for building an impact. And in a way, our question across the sector is, what would it take to do a whole lot more of this? Because as you say, Melissa, this is important to the New Zealand economy, but also important internationally. So impact is where we get the finance to make the climate transition, to regenerate nature, to address social issues. So let's kind of turn the question around and say, so from your perspectives, why isn't there more of it? Where are some of the barriers? And Simon, you alluded to a slow take-up in terms of consumer demand. Are there other barriers that you see that would constrain the development of other dedicated impact funds within mainstream investing?
Yeah, barriers is probably a strong word. Mild irritants or inhibitors might sort of change the language slightly. The biggest obstacle is simply that it's hard. There's a lot of work. It's not a lot of work to issue not some trouble here, but it's a very surmountable amount of work to issue a responsible screens for harm, or perhaps tilts towards things like companies with more female representation in management or better carbon footprints, for example. But impact investing is a whole new kettle of fish that requires a lot of work. So perhaps if for other large fund managers, because I think you point out the big brands in the market, well, Harbour and Booster, you've kind of got the mainstream here who have dedicated funds, but the bigger brands haven't gone along the journey yet, and perhaps they see that as a bit of a barrier. I would say that's something that will get broken down in time. The other things that are very much in the mild irritant category, I think it's the measurement that takes time. Perhaps the debates about the different definitions haven't been particularly helpful, because people want to steer clear of being on the wrong side of that debate, or just sort of bad headlines. Another aspect would be there's a lot of grey areas as to what is impact, and you have to navigate that. So we've got on board an impact committee, and it's got some external members in there just to help us hash out what reasonable clients would expect to see in their portfolio, what's impact and what's not.
So we've just actually had a question in from Hugo Miller. Thanks, Hugo. Very, very good question. What Hugo's saying is obviously measuring impact in a rigorous way is very difficult, very expensive. Often the data isn't available to do so. And he says, is it often the case that telling the story of the impact can be a more kind of realistic way to get the message across and attract capital? Simon, do you want to comment on that?
Yeah, I wish that was all you needed to do. And I think stories are really important. It's a narrative grips people. You can feel a story more than you can data. But coming back to my earlier point on measurement, I think it is really important, particularly as impact investing as a movement tries to retain its integrity. I just think the measurement's needed, and it's hard, but it is requisite.
Yeah. Melissa, how about you? Where do you see the inhibitors, perhaps, rather than barriers to the growth of impact investing?
Well, I think part of it is about getting that scale, and we're starting to see some really good options come through for people to place their money, and then it's thinking about how they can responsibly start to put an allocation in and build that over time as the portfolios get traction. I think there's no question people want to put their money to work, and they want to do it in a considered way. So I think, taking steps, taking them along the journey, starting with those stories, and also, that commitment to measuring those stories. And I think, really people are asking for ways to invest, and then they want to be able to move in and out on their own investment time horizons, because there's no point saying, to someone who's nearing retirement, put your money to work here for 20 years, but they can kind of come in, support that journey to impact, and then exit to, ensure they've got their financial well-being intact. So it's about spreading, educating people across a portfolio And there's a lot that can be done with just increasing that allocation of capital here. We can't solve it in a year. I think the commitment's there, the tools are coming.
Yeah. So in this project that we're doing to accelerate mainstreaming of impact, I'm working with a colleague, Justine Sefton, and we're interviewing fund managers across New Zealand, the main funds, and we're then going to be working on what ways, what can be done in order to accelerate. What are some of the tangible things that can be done? Maybe policy level, maybe capability building, might be some ways to bring different cultures together. I'm sort of very aware that the community who specialize in impact investing do a very good job of it, but that's a different community than the mainstream fund management. So there's also sort of cultural mismatches there. What do both of you see as kind of a way to take this forward and to be able to do more in New Zealand for impact investing? What would you kind of recommend that we look at?
After you, Melissa.
Well, I think sitting in certain organisations, there's a great wealth of data around some of the young companies that have been built. And so I think picking out a few of those and using them as a reference to start to really tighten up some of those measurement frameworks. And I mentioned LanzaTech before. That's a huge journey, a huge success. It's now, the Americans have claimed it as a company, a US company, but its roots and its origins are here. And they are having a significant impact in capturing, nasties from the atmosphere. So I think showing, particularly for our investor base, that these things can start in New Zealand and they can grow, and giving people options, as I said before, coming in and out around the investment horizons to realise some returns along that journey is going to be key.
I just think it'll take time, Barry, and it's encouraging to see, like, for example, the shift in focus in mindful money in the last couple of years, right? This has become a big focus for you, and that sort of filters out, and hopefully firms like Booster and Harbour have some success stories, and that filters out and gains some traction. I think when we're just thinking about the barriers, we can flip that around, and there's some, whatever the opposite of barriers are too, and that what we've experienced some sort of positive externalities in managing this fund, and it really comes down to engagement. I think whilst we've got 6 million under management, we have had some positive conversations with clients about it, but also staff. There's quite significant staff investment in it, but just staff satisfaction in the process of launching this fund and what it means to us.
Add to that, it makes it very visible and real, I think, bringing it to grassroots and seeing what can be done.
We're really keen to do more, because it's about the aspiration where people can not only invest ethically to avoid stuff that they don't want to see in their portfolio, but at the stage you're able to inspire people with saying, yes, my money, my KiwiSaver account can do some good in the world. There you open up a whole new conversation and a new rationale for investing. And interestingly, in our annual surveys, we asked members of the public, if you felt like your money was making a positive difference, would you save more? And the interesting thing is, a lot of people say yes. And in terms of public policy about boosting savings levels in New Zealand, unfortunately, we don't relate that to where the money is invested, and to say, well, actually, this should be a factor in encouraging people to save, and they can realise that actually their funds can make some benefit. We're going to have to close here because it's 1 o'clock, and my thanks to both of you for a really interesting conversation and for the work that you do. People, of course, can find out more about these funds looking at Booster's website and Harbour's website. So we're really grateful for you coming on and not only talking about your funds, but also more broadly across the sector. So thank you very much. Thanks also to our audience for joining us. As I say, we do these seminars each week and or each fortnight. We've had a little delay before doing this one, but we're also planning our next few. So please do check in to find out what's happening next on our website. I want to thank our general sponsors for the website. It includes Mercer, New Zealand Green Investment Finance, Alphinity, Medical Assurance Society, as listed up there. Also, as you see, Chapman Tripp, Booster, thank you, Melissa and your team. Harbour, thank you, Simon and your team. Trustees, executors, Pathfinder and Pythons. So that's the support of those sponsors really valuable. And just to close, we do face some absolutely massive and urgent challenges kind of at these recent months with wild weather, the huge damage and disruption to people's lives, the kind of the suffering is just a reminder that unless we step up to issues like climate change, things are going to get a whole lot worse before they get better. And I'm constantly reminded that we're at 1.1 degrees Celsius temperature rise. Business as usual would take us over 3 degrees, and that would mean that what we're seeing now is absolutely the tip of the iceberg. So more power to those who are working on impact investment in the audience. As I said, some great funds out there. We have some information on the Mindful Money website under an impact directory. Not quite up to date, but there's some great companies listed there, some great funds listed there. So thanks for your support, and thanks to you all for checking in on the seminar. Next week, we're looking at basically how people can take the first steps towards investing ethically. So please join us then. We've also got a great seminar coming up on forest management in New Zealand. So thanks again. Ka kite ama.
Thank you.